The second and most obvious way in which directors become personally liable for the debts or consequences of failure of their businesses is through matter of insolvent trading. People have some really serious misconceptions about what insolvent trading is. People have some ideas that they can look at their balance sheets, and as long as they've got, more assets than liabilities or things like that, then that's going to be a protection. But in Australia, the legislation makes it very, very clear that the test for the solvency of your business is, can you afford to pay your debts as and when they fall due and payable? If you find yourself in circumstances where that's not the case, if you are falling significantly behind and you've racked up tax debts, because that is included on the dates on which your debts are due and payable, if payments to your suppliers are falling behind, and if you get to the point where seriously more than 25 to 30% of your payments are starting to fall outside the normal trade terms of your business, you need to start to admit that actually on a cash flow basis, there is a potential solvency issue that needs to be looked at. It doesn't mean you need to step into a form of external administration at this point. There is at law a definite difference between what we call temporary illiquidity and terminal insolvency. But once you've reached the issue of one issue where you've got debts that are falling behind, you need to be able to show that you've taken positive steps to deal with the financial position of your company. Ultimately, if a liquidator is appointed to the company, we look with retrospect at all of the financial signs that are in place. And we take the view that at some point there was an overwhelming amount of evidence that a reasonable person in your position should have admitted to themselves that their company was insolvent. And if you've got debts that incurred after that date, you are personally liable for that. Now, the issue of criminal insolvent trading isn't a major one in this country, particularly for the area of small business. Less than 10 people in 2003, 2004 were found guilty of criminal insolvent trading, and they tend to be in the realm of public listed companies rather than in small businesses. The reality of the situation is the Australian Securities Investment Commission is only going to be taking action against directors in circumstances where there is a deliberate pattern or evidence of behaviour that you pre-orchestrated to incur debts that you never intended to pay. Although the ATO has been really enforcing provisions against directors in circumstances where superannuation does not get paid to employees. Almost all government regulations around businesses at the moment take special exceptions to people who trade their businesses at the expense of employees' superannuation, particularly because the government scheme that will pay out employee entitlements doesn't compensate employees for unpaid superannuation. And so therefore it is considered a significantly higher issue or breach of your duties as director if you're insolvent, leaving your employees' superannuation unpaid. Strangely enough, where you are a PAYG employee of your own companies, and therefore you are technically incurring debts to your own super funds in that regard, the ATO doesn't actually seem to provide any difference whatsoever for the fact that you haven't paid your own super to yourself, and will seek to enforce that the penalties applying to not paying your own super as if you were an arm's length employee are enforced. As I said, we look back and we, as a liquidator, and we find a date that the company was insolvent, we then will can potentially bring claims against directors for debts incurred after that date that remain outstanding. Big issue in current times is that as we move towards more electronic accounting systems, many people will keep an electronic accounting package, whether it be Xero, an MYOB, and they think that maintaining those files is sufficient to comply with your director's duty to maintain proper books and records of the company. But it's not the case. The legislation requires not only that you do keep these accounts, but that you also keep source documentation that would allow an independent audit of the content of your management accounts to be conducted by a third party. So as we start to look at, we get appointed, we get access into the Xero file. If you've got listed invoices and payments going in and out of your Xero file, but you don't have copies of the invoices kept there in support, then you're technically not compliant with the requirement to keep proper books and records. If you don't have proper books and records for any given period, your company is presumed insolvent during that period. And so there's been quite a few directors who have found themselves on the receiving end of insolvent trading claims for a significantly larger amount, purely because the standard of electronic records for their businesses that they've kept haven't been kept up to the same standard they used to be when we used to have A4 folders full of paper in our offices.
Liam, quick question regarding credit card payments. Those transactions, how do they account for?
So you probably need to be keeping your statements. They need to be itemised, and you should be able to trace through the transactions on a general ledger against a credit card statement.
Right, so example, you go to fill up petrol for $100, whatever it is.
Yep.
If you don't have that invoice...
No, you're not necessarily going to need an invoice, right, but you should be able to see on your credit card statement that there is a transaction to the local petrol station for $100 and you've accounted for it in your budget or your payments for fuel and applied it to the relevant accounts. So you don't necessarily need to have the invoice or even the receipt for it. If the credit card statement says $100 Caltex, that's going to be a reasonable standard of a record to justify the transaction.
With a bank statement, a lot of the bank statements now are telling you that as well, that you've purchased petrol from Caltex. So is that not enough?
Yes, look, the statement can be for things like your general expenses of your business. Yeah, absolutely. There's a reasonable third-party document that I can look at it and go, yeah, that payment didn't go into the director's pocket. It was payment for an expense that was incurred by the business. There's some third-party standards, okay? We don't necessarily expect every single transaction. It's on balance. There has to be sufficient to allow reasonable analysis of the books and records that you've got. The other issue to remember, though, is that as liquidators, it is not our job to punish directors of insolvent companies. Our job is to act for the creditors of the company to maximise the financial return. We don't punish directors for breaches of their duties. We're not the ones that will end up having you struck off. That is ASIC's job. We have a minimum level of reporting of some statutory information that we give to ASIC, and ASIC has a look at whether or not they want to take action for that sort of thing. Generally speaking, ASIC will only take action if you have significant amounts of unpaid statutory debts and superannuation, or a significant number of companies that have failed within a period of 5 years. As the absolute minimum, the law says that unless there are exceptional circumstances, you've got 2. The reality of the situation is that ASIC is not prosecuting small business owners for anything other than out-and-out deliberate attempts to rip off your creditors. However, the liquidator is getting as much money back for creditors as is possible. We don't bring insolvent trading claims against people if there's not going to be a commercial benefit or return. Quite often when we're appointed to companies that have no assets to them. And we're not required to undertake work in the liquidation of a company if there's no assets to meet the costs that we incur in doing our jobs. So generally speaking, while it might be that you find yourself in a situation where, for example, there is a potential claim for $500,000, I'd have to have the money to litigate that claim, and I'd have to have someone who has $500,000 to be able to pay it back to me if I was even successful. And in 90% of cases that come across my desk, I will sit down with the director and we'll have a look at what their circumstances are, and we will come to some sort of settlement where I can demonstrate to the creditors of the company, mostly of the ATO, that a commercial settlement without incurring legal costs in all of the circumstances is in creditors' best interest rather than seeking to enforce and pursue things through court. So if you do happen to have the misfortune to find yourself in this situation, communicating with your liquidator and coming to the party for real discussions about these situations is in your interest, because the ATO generally funds action against people who have gone to ground and refused to engage with the process. Defences to insolvent trading are particularly hard to defend. Reasonable grounds or illness means that you have to actually be able to show that there are solid reasons that you didn't act in the role as the director of the company, such as being critically or terminally ill and unable to do so if you were incarcerated in prison, things like that. It's a particularly high burden to get to. The reasonable steps defence is to show that you did everything in your capacity to prevent a company from incurring debts after a particular date. Generally speaking, that involves commencing legal action in the court to have an administrator appointed to the company and you were frustrated from doing so. I could talk about safe harbour for ages, but in the briefest sense, it's this. If you've acknowledged that your company is insolvent and you're working with a proper insolvency practitioner to restructure your business in a way that is likely to generate a better return for creditors, any debts incurred after you've engaged with a safe harbour advisor, you're indemnified against. So this is another case where being honest about the circumstances of your company and getting help protects you from the potential personal exposure to the debts of the company. Lastly, if you have a corporate structure, and I see this all the time, where you have a trading company and the shares in that trading company are owned by a parent entity that owns all of the assets of the company, and you have the same director for both companies, then that parent entity is going to be liable for the insolvent trading of the subsidiary company. It's not good enough for you to be able to protect the assets of your businesses in this way, because it's the same mind who has deliberately set up a strategy to try and get around the personal liability. And the Act says that that parent entity or the asset of that parent entity can be made liable or come to account for the insolvent trading. There are asset protection strategies designed to protect yourself and to protect your businesses in these circumstances. And unfortunately, way too many people have relied upon unqualified advisors when setting these things up and thought that they were safe and protected, but it turns out that it's not the case. I really do encourage you to speak with your accountants, speak with qualified and good accountants or advisors about setting up asset protection strategies and having those strategies stress tested against the circumstances of your business to be effective asset protection strategies.